Roth or traditional? It's one of the most common questions freelancers ask about retirement accounts. And the answer could save or cost you tens of thousands of dollars over your lifetime. Today, I'm going to break down exactly when to choose Roth, when to choose traditional, and the specific strategy most freelancers should use. Note: this information applies to US-based freelancers and self-employed individuals. Welcome to the Freelancers Wealth Blueprint. Let's settle this debate. First, let me explain the difference in simple terms. Traditional means you get a tax break now. You contribute pre-tax dollars, your taxable income goes down today, and you pay taxes when you withdraw in retirement. Roth means you pay taxes now. You contribute after-tax dollars, no tax break today, but your withdrawals in retirement are completely tax-free, including all the growth. Here's the key insight. The right choice depends on one question: will your tax rate be higher now or in retirement? If your tax rate is higher now, choose traditional. Get the tax break when it's worth more. If your tax rate will be higher in retirement, choose Roth. Pay taxes now while they're lower. Simple in theory, but how do you actually know? Let me give you the freelancer framework. As a freelancer, your income probably varies year to year. Some years you earn more, some years less. This is actually an advantage for tax planning. Here's the strategy. Use Roth in low-income years. Use traditional in high-income years. Let me show you with real numbers. Say you're in the 12% tax bracket this year. Your taxable income is around $45,000. If you contribute $7,000 to a Roth IRA, you pay $840 in taxes on that money now. If that $7,000 grows to $50,000 over 30 years, you pay zero taxes on the $50,000 when you withdraw. You paid $840 total. Now imagine you're in the 24% bracket. Taxable income around $120,000. If you contribute $7,000 to traditional, you save $1,780 in taxes today. That same $7,000 grows to $50,000. In retirement, if you're in the 22% bracket, you pay $11,000 in taxes on withdrawal. But you had that $1,680 tax savings for 30 years. If you invested it and it grew at the same rate, it would be worth about $12,000. So traditional in this case, saved $1,680 now, grew to $12,000, paid $11,000 taxes. Net benefit roughly $1,000. The math gets complicated, but here's the simple rule. If you're in the 10 or 12% bracket, almost always choose Roth. If you're in the 32% bracket or higher, almost always choose traditional. If you're in the 22 or 24% bracket, it depends on your expected retirement income. Most freelancers in the 22 to 24% range should do a mix of both. This gives you tax diversification. Let me explain tax diversification. Nobody knows what tax rates will be in 30 years. They could be higher. They could be lower. Having money in both Roth and traditional accounts gives you flexibility. In retirement, you can withdraw from traditional up to the top of a low bracket, then switch to Roth for additional needs. This is called tax bracket management. Here's a practical example. Say you're retired with $1 million in traditional and $500,000 in Roth. Year 1, you need $60,000. You withdraw $45,000 from traditional, staying in the 12% bracket. You withdraw $15,000 from Roth, tax-free. Your total tax bill is minimal because you managed which bucket you pulled from. If all your money was in traditional, you'd be forced to pay taxes on every dollar. If all was in Roth, you missed years of tax deductions that could have been valuable. The mix gives you control. Now, let me talk about the accounts available to freelancers. For IRAs, you have a clear choice: Roth IRA or traditional IRA. Contribution limit is $7,000 in 2026, or $8,000 if you're 50 or older. Income limits apply to Roth IRA. If you earn over $161,000 single, you can't contribute directly. But you can do a backdoor Roth, which I'll explain in a moment. For solo 401k, you can split your contributions. The employee portion, up to $20,500, can be Roth or traditional. The employer portion is always traditional. This is powerful. You could put $20,500 as Roth and another $15,000 or more as traditional employer contribution. Best of both worlds. For SEP IRA, there's no Roth option. All contributions are traditional. This is one reason solo 401k is often better for freelancers. Let me give you the backdoor Roth strategy. If your income is too high for direct Roth IRA contributions, you can still get money into Roth. Step 1. Contribute $7,000 to a traditional IRA. Don't take a deduction. Step 2. Convert the traditional IRA to Roth IRA. Step 3. Pay taxes on any gains between contribution and conversion. If you convert quickly, this is nearly zero. Result: $7,000 in your Roth IRA regardless of income. This is completely legal and used by high earners everywhere. There's also the mega backdoor Roth for solo 401k, but that's an advanced strategy for another video. Here's your decision framework. Question 1. What's your tax bracket this year? 10 to 12%. Favor Roth heavily. 22 to 24%. Mix of both. Maybe 50-50 or 60-40 Roth. 32% plus. Favor traditional heavily. Question 2. Do you expect higher income in the future? If yes, use more Roth now while your bracket is lower. If no, traditional might make more sense. Question 3. Do you have any Roth money already? If no, prioritize getting some. Tax diversification matters. If yes, consider your overall mix. Question 4. How long until retirement? Longer timeline favors Roth. More years for tax-free growth. Shorter timeline might favor traditional for immediate tax savings. Here's what I recommend for most freelancers. In your 20s and early 30s, favor Roth. You're likely in lower brackets and have decades of tax-free growth ahead. In your peak earning years, late 30s through 50s, use a mix. Max traditional in high-income years, switch to Roth in lower-income years. As you approach retirement, consider Roth conversions. Convert traditional to Roth in years when your income is lower, filling up the lower brackets. The freelancer advantage is income flexibility. Use it strategically. Here's your action plan. First, check your current tax bracket. Look at last year's return or estimate this year. Second, decide on this year's strategy based on the framework above. Third, if you have a solo 401k, consider splitting contributions between Roth and traditional. Fourth, if you only have traditional money, open a Roth IRA and start building that bucket. Fifth, revisit this decision every year. Your income changes, so your strategy should too. The worst choice is analysis paralysis. Both Roth and traditional are good. The important thing is to contribute. That's the Roth versus traditional breakdown for freelancers. If you found this helpful, subscribe for more freelance finance content. As always, this is educational content, not financial advice. Talk to a tax professional about your specific situation. See you in the next one.